Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open one of the most fascinating enterprise software stories in the market right now. ServiceNow, ticker NOW.
And I'm Lana Chen. ServiceNow is the company quietly becoming the operating system for how large organizations actually get work done. And right now, the stock is sitting at a very interesting inflection point.
Interesting is one word for it. The stock is down about 50% from its highs, trading around $95 a share, but the business underneath, still growing north of 20%. That's a pretty wide disconnect, and we're going to unpack all of it today.
Let's start with what ServiceNow actually does, because a lot of people hear IT service management and their eyes glaze over.
Fair point. So ServiceNow was founded in 2004 in Santa Clara, California. At its core, they built the Now platform, a cloud-based workflow automation engine. Think of it as the central nervous system for big enterprises. When your laptop breaks at work and you submit a ticket, that probably runs through ServiceNow.
But they've grown way beyond help desk tickets. Today, the Now platform spans IT, HR, finance, customer service, supply chain, legal, and procurement. They have over 8,000 enterprise customers, and 97.5% of their revenue comes from subscriptions. That is an incredibly sticky business model.
And the man running the show is Bill McDermott. This guy has one of the best origin stories in business. At 16 years old, he bought a deli on Long Island for $7,000. Went on to run SAP, the largest European software company, where he grew its market cap from $39 billion to $163 billion. Joined ServiceNow in November 2019, and he's more than tripled annual revenue since then.
McDermott is known for his relentless growth focus and what he calls his underdog desire mentality. He also just put his money where his mouth is. In February, he bought nearly 29,000 shares on the open market at around $105 a share. That's a $3 million personal bet on his own company. And it wasn't a pre-planned sale. That was a deliberate open market purchase.
I love seeing that kind of skin in the game. All right, Lana, let's get into the numbers. Take it away.
Let's start with valuation. ServiceNow trades at 61.1 times trailing earnings, which sounds expensive. But here's the thing. The forward PE is only 23.4 times. That gap tells you the market expects significant earnings growth ahead. Price to sales is 7.9 times, EV to EBITDA is 21.5 times, and the PEG ratio is 0.93.
A peg below 1 on a company growing this fast, that's actually pretty compelling on a growth-adjusted basis.
Exactly. Now let's look at the top line. Trailing 12-month revenue came in at $13.28 billion, growing at 20.9% year over year. Their quarterly revenue trend tells a clear story. $2.87 billion in Q1 2025, $3.09 in Q2, $3.27 in Q3, and $3.57 in Q4. That's steady, accelerating growth quarter after quarter.
And almost all of that is subscription revenue, right?
97.5% subscription mix, with subscription revenue growing at 21%. EPS came in at $1.69 trailing, with earnings growth of 21.9%. Gross margins are an impressive 77.5%. Operating margin sits at 13.7%, and net margin is 13.2%.
Those gross margins are elite for enterprise software.
They are. Now, cash flow. This is where ServiceNow really shines. Free cash flow hit $4.6 billion, giving them a free cash flow yield of 4.6%. The free cash flow margin is 34.5%. Operating cash flow was $5.2 billion. When you see a company converting over a third of its revenue into free cash, that's a very well-run operation.
34.5% free cash flow margin. That's almost unheard of at this growth rate.
On the balance sheet, they're in fantastic shape. Total debt is just $1.5 billion, and they actually have net cash of $2.2 billion. Debt to equity is 1.01, and the current ratio is 1.15. This is a company that could self-fund its growth without touching the debt markets.
And then there's the backlog, which I think is one of the most underappreciated numbers here.
Absolutely. Remaining performance obligations, essentially contracted future revenue, stand at $28.2 billion with 26.5% growth. Current RPO, which is the portion expected to convert to revenue in the next 12 months, is $12.8 billion, growing at 25%. That kind of revenue visibility is exceptional. Overall, ServiceNow's financial health is strong. High growth, elite cash flow margins, net cash on the balance sheet, and $28 billion in contracted backlog.
Love it. All right, let's talk about what Wall Street thinks. The analyst consensus is a strong buy with 53 analysts covering the stock. 42 have it rated buy, 3 are at hold, and just 1 at sell.
The median price target is $182.50, which implies about 92% upside from current levels. The range goes from a low of $122.78 up to $260.
Some notable recent calls. Goldman Sachs' Kash Rangan maintained his buy rating, but trimmed the target from 216 down to 188. Morgan Stanley's Keith Weiss has an overweight with a 245 target, pointing to AI monetization as the key catalyst. And Piper Sandler's Rob Owens is at overweight with a 220 target, saying the federal government opportunity is underappreciated.
On the more cautious side, BTIG cut their target from 200 to 185, citing scrutiny on fiscal year 2026 revenue growth guidance, and Stifel came down to 135 from 180. So there is some dispersion in the targets, but the direction is overwhelmingly bullish.
Now, the insider activity we already touched on, McDermott's $3 million open market buy in February. Net insider buying outpaces selling 2-to-1 over the last 90 days. When the CEO is writing personal checks at these levels, that's a signal.
And the options market is telling an interesting story, too. The put-to-call ratio is 0.44, well below the market average of 2.83. That's heavily skewed toward calls. Implied volatility is in the 90th percentile at 53%, which makes sense with Q1 earnings on April 22nd, just 9 days away. Heavy call open interest is clustered at the 110, 120, and 130 strikes.
So options traders are positioning for a move higher around earnings. That's worth noting. Now let's get into the big story, the bull case for ServiceNow.
The number one catalyst is Now Assist, their AI product. It hit $1 billion in annual contract value run rate in March 2026. That is the fastest product ramp in company history. These AI agents are saving enterprise workers roughly 1 day per week, and the company projects that will reach 2.5 days per week as the technology matures.
$1 billion in ACV in essentially 18 months from launch. That's staggering for an enterprise product.
The second catalyst is federal government. The GSA OneGov deal from September 2025 offers federal agencies up to 70% discounts on upgrades to ITSM Pro and Pro Plus bundles. In February 2026, MoveWorks, which ServiceNow acquired, achieved FedRAMP moderate authorization. They're pursuing FedRAMP High and IL5 clearance to unlock classified workloads. Public sector is now roughly a third of their business, growing 30% year over year.
A third of ServiceNow's business is government. I don't think most investors appreciate that.
Third catalyst, platform expansion. ServiceNow started in IT, but they're now cross-selling HR, finance, supply chain, customer service, and legal workflows into their existing base of over 8,000 enterprise customers. The MoveWorks acquisition adds conversational AI across all those verticals. And fourth, international expansion into regulated industries, healthcare, financial services, and government, where compliance requirements create even higher switching costs.
All right, let's flip the coin. What are the risks?
Risk number 1, valuation. Even after a 50% drawdown, the stock trades at 61 times trailing earnings and 7.9 times sales. If AI monetization takes longer than expected, there's room for further multiple compression.
That trailing PE is still eye-catching, even if the forward multiple looks reasonable.
Risk number 2, Microsoft. Copilot and Teams AI agents could erode ServiceNow's position as the workflow interface layer. Microsoft has deep enterprise relationships and could bundle competitive functionality into existing licenses. Risk 3, AI commoditization. ServiceNow needs to prove sustained pricing power as generative AI capabilities become more widely available. The Pro Plus premium of 25 to 45% works today, But that could face pressure. And risk 4, macro headwinds. Tariff uncertainty, budget pressures, or a broader enterprise IT spending slowdown could slow that 21% subscription growth trajectory.
Those are real risks, and I appreciate that you laid them out plainly. Now, how does ServiceNow stack up against its peers?
Against Salesforce, CRM trades at 53 times earnings with revenue growth of just 8.7% on a much larger revenue base of $37.9 billion. Higher operating margins at 20.5%, but significantly slower growth. ServiceNow is growing more than twice as fast.
So Salesforce is the mature giant, and ServiceNow is the high-growth challenger.
Against Workday, WDAY trades at 38 times earnings with 16.4% revenue growth, steady and lower volatility, but weaker operating leverage at just 6.2% margins. And then DDOG trades at 65 times earnings with the highest growth at 25.8%, but from a much smaller $2.68 billion revenue base and razor-thin 3.8% operating margins. ServiceNow hits the sweet spot. It has scale, growth, and profitability. That combination is rare in enterprise software.
So ServiceNow essentially sits in the Goldilocks zone, big enough to be durable, growing fast enough to justify a premium, and profitable enough to generate serious cash.
That's a fair summary. The PEG ratio of 0.93 versus Salesforce at around 2 and Datadog at 2.5 suggests ServiceNow offers the best growth-adjusted value of the group.
All right, let's bring it home. Here's the bottom line on ServiceNow. This is a company with $13 billion in revenue, growing over 20%, with elite free cash flow margins and $28 billion in contracted backlog. The stock has been cut in half, but the business hasn't missed a beat. AI monetization through Now Assist is real, $1 billion in ACV and accelerating, and the CEO just put $3 million of his own dollars on the line.
The single most important number to watch is the Q1 2026 earnings report on April 22nd. Specifically, watch current remaining performance obligations growth. If CRPO growth holds above 25%, it signals the demand engine is intact and the forward multiple re-rating has legs.
And on that note, here's a quote from Bill McDermott himself from the Q4 2025 earnings call. He said, "Right now we're in an agentic AI moment where the industrial software complex of the 20th century is being integrated and in some cases drastically reduced in numbers of applications and moved to the ServiceNow platform."
Bold words. But when your backlog is $28 billion and growing 26%, you've earned the right to say them.
Before we close, if you want deeper research, full financial breakdowns, and the complete transcript of every Charged Alpha episode, head over to chargedalpha.com. It's all there, and it's all free. We do this because we believe every investor deserves access to institutional quality research.
No paywalls, no gimmicks, just the data.
That's our deep dive on ServiceNow, ticker now, episode 96 of Charged Alpha, the S&P 500 stock encyclopedia.
Until next time, do your homework and stay curious.
Disclaimer time. This podcast is for informational and educational purposes only. Nothing you hear on Charged Alpha constitutes financial advice, investment advice, or a recommendation to buy or sell any security. We are not licensed financial advisors. All data presented is sourced from publicly available information and may contain errors or become outdated. Always do your own research and consult a qualified financial professional before making investment decisions. Past performance does not guarantee future results. Investing involves risk, including the potential loss of principal. This episode was produced with the assistance of artificial intelligence tools for research compilation and script generation. All facts have been verified against public sources, but listeners should independently confirm any data before acting on it. Charged Alpha has no financial relationship with ServiceNow or any company discussed in this episode.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.